Now you have billions of AUM in ETFs and embedded in managed funds by some extremely large organizations, and they can't really undo it.
I'm not quite sure that the infrastructure today is the key barrier to institutional investors. I think that the key point now is pain.
Bitcoin is the internet of money, and the future of that is settling all assets on Bitcoin layer 2 technology, which is robust, dependable.
Big institutions, they're conscious that the risk for them today is probably bigger in missing the next upward cycle rather than...
Each day out of market feels more risky to me than staying in the market. Surprisingly, given that one of the promises of the blockchain, other than Bitcoin the asset, is settlement and robust smart contracts. I mean, not VM smart contracts, but simplicity contracts or something dependable, is that you don't need a custodian. In practice, most exchanges, like Bitcoin derivatives exchanges, are the commingled custodian without proper legal segregation. And you've seen situations even where you have custodians that are handling multiple asset classes and they have a security failure in a VM-based blockchain, and then the Bitcoin holders that were using that custodian or the companies that were using that custodian end up a fractional claim against a bankruptcy when no Bitcoin were lost. So I think actually learning from the existing market structures of having independent custodians and a reliable transport. So we've been saying that Bitcoin is the internet of money, and the future of that is settling all assets on Bitcoin layer 2 technology, which is robust, dependable, and confidential, importantly as well, because you don't want to open source, sort of have open intel front running everything in the market. So I think Liquid is a vehicle to do that, and I think that is creating a lot of risks in the market, and therefore creating risk premium, and it may actually end up driving the business away from the earlier stage derivative exchanges and crypto exchanges and into the traditional financial markets. So it's ours to lose to ours, the broader Bitcoin and ecosystem, to lose in not getting smarter about separating custody from trading venues, about using robust technology for handling the long tail of digital assets that people are going to do them, and for tokenizing shares, and for the simple smart contracts that actually deliver value. I mean, most financial contracts in the global capital markets are actually composed of 12 specific and narrow types of contract, which are not, ultimately that complicated. So, you don't need a VM-based smart contracting language to robustly deliver those kind of contracts. And so I think that's the potential is unlocked by having the ability to make a financial contract that is robust and safe to put out in the network, and you won't suffer billions of dollars of hacks and losses a year.
Yeah, so I would say, building on that there's a couple of interesting things that jump out from my experience from a TradFi world. One being what Adam was mentioning about separating custody from exchanges. And so we're just now kind of starting to see this come into play with this mirroring of collateral or tri-party agreements. So I'm really looking forward to seeing that build out more and further. I think that Komeinu is doing that, where they have the custody at Komeinu. You can have Bybit or OKX or some of these other exchanges that will reflect what the Bitcoin held on Komeinu to the exchange. But it's still a pretty rare thing to see. I think BitGo has a couple of those going, but those are kind of the two right now. So I think that will become more of an industry standard over time. I think that for institutional investors to get comfortable, they want to know that the Bitcoin is safely held in custody. I think another area that's would, from my perspective, from coming out more of a lay person, like is probably not quite as advanced as some of the other players, would be that if we could get like an Apple and a Google to kind of really onboard simplified key management, right? So, just make it really easy for people to manage their keys, and just where you don't even think about it, it's just there. It works. It's simple. If there's a problem, there's somebody to call. That would be really interesting. Now that it's not for everybody, right?
Or maybe recover the funds if you lose all the keys. That would be great.
Yeah,
Peace of mind.
I think that type of stuff would also. I mean, there's going to be security cases where you never would want to share that stuff with Apple or Google or whatever. But then for my brother or somebody that's maybe an architect that wants to have Bitcoin, but they get really nervous about that key storage. So kind of making simpler solutions there would be fun.
Yeah, I would
Julien.
just argue that I'm not quite sure that the infrastructure today is the key barrier to institutional investors' appetite. I think the appetite is there. I think that the key point now is pain. People felt the pain in different, let's say, bullish markets on Bitcoin. And the first one, obviously, they were looking at this as an esoteric asset that nobody really understood. It will go to zero, obviously. And then you had a big drawdown. And then you had the second bullish market, and so on and so forth. So today, I think that we are actually in the perfect spot for wider adoption. And I'm not quite sure it's an infrastructure question. Obviously, the final thing to say is that the Bitcoin ecosystem, I think I haven't seen any area that is comparably innovative. So I'm not really worried about that. But obviously, I'm far from being a specialist on digital assets infrastructure. But I think that the key point now is pain, is the next bullish market in Bitcoin. I think all the major institutional investors are looking at that for quite a while, and now it's probably the time where we're having some calls asking, is this the good time? So I think that the key point is not infrastructure, is pain from the guys that are not in the market yet.
And probably, and we were discussing this as Blockstream Capital Partners yesterday, the Bitcoin Corporate Day. Our colleagues on the panel was mentioning that there is a benchmark missing. How do we benchmark Bitcoin? The chief investment officers going internally trying to justify, and explain why Bitcoin would be definitely an asset to bring on the portfolio, but where is the benchmark, right? That is so. Absolutely right. Probably it's not a matter of technology infrastructure. It's a matter of different tools required for the industry. So this brings me to you, Adam. So for 15 years, Bitcoiners have talked about replacing parts of the financial system. I was one of them. Today, Blockstream is building many of those components. Which parts of traditional finance do you think will survive in a Bitcoin standard world? And which do you think will completely disappear?
Well, I mean, I think that the Bitcoin markets have things to learn from traditional markets, because traditional markets have evolved over a long period of time and adapted to, different kinds of market stresses and how to robustly handle those. So I think some of it is good, and often, different crypto ecosystems just repeat prior centuries' mistakes or fraud patterns or something, right? So I think from that point of view, it's important to learn. And I think clearly the separate custody from the exchange venue is something that traditional markets have done for a very long time to isolate and protect the assets. And those aren't even Bitcoin. So there's no key loss scenario, but it's just a kind of legal separation that to just make really sure that the trading venue doesn't take your assets if it fails as a business. You can just transport them to another entity without getting pulled into a bankruptcy like with FTX and Mt. Gox and all these things. So the traditional markets experienced that, 50 or 100 years ago in some cases, and took, structural changes to do that. So I think that's important. Now, I think that the blockchain, and Bitcoin's the most robust example of that, is a very interesting and improved way to settle digital share certificates effectively, whether that is a certificate for a stable coin or a public stock or some kind of derivative instrument. I think that is a much cleaner settlement mechanism than the T+2, the prime broker kind of post-trade settlement and reconciling of errors. That's very high friction and error prone and human involvement. And I think that the kind of global settlability is actually a huge advantage in kind of a technology refresh of that whole landscape. And also, I think another way to look at things is a lot of derivatives contracts are effectively executed or settled in the back office of a trusted institution. And because people need to trust the institutions with trust, i.e. with size and reputation, are able to charge a lot of money for that. And so that places a kind of barrier to entry in cost terms to even issue such an instrument. And if you can use a simple and robust smart contract to have an open fabric for settling and executing these contracts, then you can introduce like more market efficiency and less need to trust the institution's back office, and ultimately have a longer tail in access to markets, and so more market efficiency, better capital formation, more global access to capital markets, more global access to trading opportunities. You see with some of the an active example of that now is some of the Bitcoin treasury companies that are listed on international markets. There's a Brazilian one called Orange. There is some European ones like Capital B, H100, some UK ones like B HODL. And these are sometimes on like a small cap exchange like Nordic Growth Market, UK Aquis, or even the Paris Euronext. It's not always easily accessible to somebody in Canada or the US or China, and their market hours are different as well. So, and of course, then you've got MetaPlanet as well, another time zone in Japan. And so, with the tokenized stocks, you kind of have a globally accessible ADR. And you're starting to see markets move towards 24/7 trading, which of course, the Bitcoin markets never sleep. You have a 24/7 liquid market. I think for the stocks that Bitcoiners are interested in, they want that kind of experience, and that, having global access to a market expands liquidity and improves pricing and so on. So I think these are all good phenomena, and you're actually seeing like a positive reinforcement of the traditional markets expanding out of hours, in some cases moving to 24/5 as a precursor to 24/7. And of course, ADRs between markets, the Frankfurt ADRs are quite good because you've got 8 a.m. to 8 p.m. in Europe, which is a really long market hour, much better than Japan, let's say, which from Europe opens at 2 a.m. and then they take a lunch break and then, it's closed again not long after. So these kind of phenomena of using the benefits of using an open fabric in a 24/7 market. Now, not everybody's a trader or interested or cares about this kind of thing. They're interested in Bitcoin, the asset class. But what we're saying is that Bitcoin, the asset class, also has the most robust technology base. And so we're advocates of using Liquid, which is constructed using that. And so you overcome the bridge of having dependable and robust open fabric. Otherwise, the phenomena you see is typically many of the financial institutions actually have private networks or private instances because they've realized through experience or by looking at the news over the last decade that the VM-based smart contracts chains, of which there are many, are not ultimately, don't appear to be converging on security. Initially people might have said, well, okay, there are teething problems, perhaps they'll fix the security, but it doesn't seem to be fixable. And I think that is a factor in technology, that sometimes you have a technology that's just too complicated and fragile, and the only chance to improve that situation is to first start with a secure and robust system and build features on top of that. And there's even a computer science law which is based on this observation called Gould's law. You can look it up, but it seems to be actually something fundamental about technology architectures.
And then you mentioned the benchmarking, which I think is another really interesting piece for institutional investors. When we were in the Santa Clara pension fund, when we made our allocation of Bitcoin, it was pretty straightforward. It's passive, right? But the next step for institutions would be to be allocating to fund managers. And so, you can look at fund managers versus Bitcoin, how much alpha are they creating over the fund? But then it's also helpful if you have like a universe of fund managers that you can kind of look at to see how they're doing. And that's still something that's very early stage in the ecosystem's development, that there's not a whole ton of managers yet to build an index to be able to compare a manager to. So I think that's something that will continue to develop, and that will make it a little easier for institutions to deploy capital to as we go forward.
So, and Sean, you're leading the efforts with BSTR. What do you think investors still misunderstands about capital structure in Bitcoin treasury companies?
Oh, well, I think a Bitcoin treasury company is essential premise is to increase Bitcoin per share, right? And that's really the mission. So, and I think we followed Mr. Saylor's panel, and I think he probably laid it all out in terms of like what the key objectives, how are they doing it, and it does seem like what they've created at MicroStrategy, the stretch security, or what Strive has created with SATA is a very efficient way to provide amplification to the common shareholders' stock, which would then also accelerate the accumulation of Bitcoin per share. I think one thing that's really interesting for BSTR, and one way that we're trying to really differentiate ourselves from other treasuries, is that we are looking at actively managing the Bitcoin treasury. And so when we went out raising money in July of last year and kind of socializing the idea, that really was not something that was even really discussed out there. I think that made it pretty unique, and we had a really good turnout with investors as a result. I think now that message has been socialized quite a bit, and we're hearing more treasuries that are, hey, you know what, that makes sense. We should also be actively managing our Bitcoin. And so some of these strategies with generating yield on your Bitcoin or generating alpha on your Bitcoin are now becoming much more widely accepted within the treasury community. And so I think that that's probably one of the things I think that BSTR has contributed to the ecosystem, is the idea that before MicroStrategy is not really interested in active management. They're credit oriented strategy. I think now we kind of kicked open that door for other folks to follow that path.
Thank you, Sean. And we often hear that Bitcoin is the perfect asset. So, Julien, if that is true, why are we still so early in Bitcoin-based investment strategies?
I think that there are different reasons for that. One of these reasons is that, of course, we had a massive development of strategy types, extremely sophisticated talent actually trying to deliver good returns, risk-adjusted returns. It's not just long only or ETFs. This is already there. Now, I think that what is missing, but we're slowly but surely getting there, is critical mass. Because most of these strategy providers, they're still relatively small. So there are many things that we can do in traditional finance, or we do traditionally in traditional finance, that is just not possible for them to do. which is all the boring stuff, but all the boring stuff that actually is really useful to the final investor. I'm speaking about risk management, governance, every single layer of de-risking the adventure and investing in a strategy in Bitcoin, so or digital assets in general, but Bitcoin as well. So I think that the next stage that will enable that to happen is actually the creation of companies whose social value is actually to provide exactly that. There are things that traditional markets, financial markets, have done quite well. And one of these things is absolutely is that compartmentalizing the investment decision from the checks and balances that need to happen around a fund manager, for instance. Never ask a fishmonger if his fish is fresh. You know the answer already. So you need an independent department to actually make sure that the fish is as fresh as the fund manager is saying or selling. So I think that in a sense, what is the enabler for that to happen is the emergence of companies that whose proposition is exactly that: de-risk the investment experience from the final to the final investor.
So diversification in the risking, it's definitely.
Diversification is definitely one of the areas where this will happen. So I have a broad range of different strategy types that will answer actually to each one of these specific investors' risk profile, risk appetite, and return, let's say, wish. So the maturity, the type of liabilities that he may have. So for pension funds, for instance, it's not just about returns, it's about liabilities as well. So all these things that traditional finance did produce in a quite effective way is actually now getting into the digital asset space. So once that is there in critical mass, we'll have massive flows and pain. Sorry.
And pain, yes, as Michael said. So switching gear, a capital markets panel wouldn't be a capital market pants without talking about regulations, right? So Adam, in Europe we have seen, of course, MiCA, and then in the States, the Genius Act and the Clarity Act. So which regulatory framework is most likely to accelerate Bitcoin capital markets rather than simply regulate it?
That's a good question. I mean, I think that generally the more open for business administration in the US in this cycle has been positive in enabling or encouraging different, like, larger financial institutions to get involved. So you saw, a number of spot ETFs get approved. That was actually under the previous administration via the court systems in the US. And the BlackRock ETF has been extremely successful. I think some of the regulations have opened the door for the big custodian banks to enter, which is important because institutions like pension funds and so on, they have existing custody relationships for their other assets, their bonds and their shares. And so if that same institution can provide Bitcoin custody, they would use that and it'd be one less hurdle. So, we might think, well, there are lots of digital custody specialists, but that's a hurdle. They have to qualify them, they have to adapt, they have to integrate them. So I think that's also helping. And then I think just the open for business stance helped get Bitcoin more recognized in other jurisdictions. And so, it looks like Japan is becoming more open for Bitcoin, improving Bitcoin taxes, being a bit more open for business, and the UK as well with the Financial Conduct Authority. So, and I think those changes are not really reversible, because sometimes people wonder, well, what about the next administration? Will they roll it back? And I think they can't really, because now you have billions of AUM in ETFs and embedded in managed funds by some extremely large organizations, and many different individual owners of those, and they can't really undo it. So they will keep the status quo, basically. So I think that it's good. It's a form of progress. It came piecemeal, some by the courts, some by the regulation. So I'm not necessarily thinking of regulation as a solution, but for institutions, they do look for some kind of approval, and sometimes there are barriers if they don't have the approval, like regulatory capital or legal frameworks. So clearly, whatever happened has improved the situation.
Sean, what's your stand on the,
Well,
treasury?
it is. It's been pretty interesting in terms of just watching the sausage being made with the Clarity Act and just how much trouble they're having with it. And I do think that we're also seeing. So Clarity is probably 50-50 whether that goes through. And of course, it's kind of the banking lobby, the American Bankers Association, has really been aggressive about. Like for example, a de minimis tax on Bitcoin, which should be $10,000 like it is for cash in the United States before we have to notify the IRS. But they've got it at $200. All right, and so there's just all these things that they've done with this act that's kind of like Frankenstein. But you have seen the regulatory agencies also be more assertive with the current administration. So we had the no action letter with the CFTC for Coinbase recently, and that was a nice thing to see. So I think even if Clarity Act doesn't go through, I think the current administration or I guess the appointed heads of the different agencies that represent the administration will be more aggressive about perhaps providing guidance to the industry. So hopefully, we will get progress with or without clarity.
Yeah, so it's all work in progress. So Julien, then which single regulatory developments, MiCA, Genius Acts, Clarity Acts, or something else, would unlock, do you think, the largest wave of institutional Bitcoin?
I would say, so I will be annoying and cheeky. I think all of the above and none of the above, in the sense that once more in my traditional finance past life, I spent quite some time designing solutions to clients for them to get exposure to things in a certain way. So you can always find loopholes. I think I've seen Yves Schwefati earlier today saying that actually if you want to invest in Bitcoin, of course you can invest in Bitcoin directly, but you can invest in companies that would profit in Bitcoin, etc., etc. So I think that the biggest thing that needs to happen right now is increasing in the critical mass of people investing in the ecosystem itself, not necessarily directly Bitcoin. And the good news is I'm quite convinced that this is actually happening. The types of discussions that we're having with big institutions is very different now than what it would be 2 years ago or 3 years ago. They're conscious that the risk for them today is probably bigger in missing the next cycle, upward cycle in the industry, rather than to be at risk from a regulatory point of view. So I think that once more, it's not. I'm not sure it's a regulatory question. Most of the times, from my understanding, regulation end up following what is going on in the market. It's not a starter for something. It follows. So if big institutions really see an interest in getting into that space as an underlying, and they are, for all the fundamental reasons actually that Bitcoin was based on, they will make it happen in one way or another. They will find the loopholes. There was just as a quick example, there is a legislation in the US that is called the 40 Act legislation. This is to regulate investments by pension funds. And in theory, this should limit the amount of derivatives that pension funds should be investing in. I did design in the past a quantitative way of actually making investments through derivatives that would allow pension funds to invest in strategies that would trade 50,000 derivatives per day. So the technical solutions will be there. It's better if the regulation is obviously friendly because it decreases the cost of engineering solutions to get to that P&L. But I think that the key point today is actually the next cycle. It's pain. It's all these guys that have watched Bitcoin as an asset evolve from something weird to not weird, but exotic, eventually risky. And now it's actually, I think, at the verge of becoming really integrated as an asset.
Attractive, yes. And as Seller was mentioning before, it's a matter of becoming general wisdom. Then once it becomes general wisdom, you have less friction from a regulatory perspective, and more kind of becomes more of an enabler of integrating these complex adaptive
and then the
systems
regulator
because-
doesn't have the choice.
Right.
He has to
So,
follow.
Thank you, Julien. The last question to the panel. It's a cross question, so crossfire question. So imagine a public CEO, public company CEO, comes to each of you and says, "I have 1 billion in cash. I'm convinced about Bitcoin. What should I do next?" What would you do? What would you recommend? Just buy Bitcoin, or
Yeah, just buy Bitcoin. Do it quickly. I mean, there are some debates about timing the market, dollar cost averaging, and these kinds of things. But and slipping the market if you do it too fast. But these days, I think buying a Bitcoin could be achieved quite quickly without moving the price with OTC and spreading it out over a little bit of time. So I think that's no longer an issue. Going back a few years, it might have moved the market. Yeah, and I mean, of course, they could do it in some derivative or hybrid way as well. But just buy Bitcoin and hold it, or buy an ETF and hold it, or buy a treasury company that you like and hold that, or some combination.
sure.
I would.
Best in BSTR.
Yeah, I was going to say, I would, because he said at the end there, buy a treasury company. So I would advise buying BSTR.
Of course. Julien?
I would say buy a little bit of Bitcoin, buy a little bit of treasury companies, and then speak to guys who have also a significant, let's say, wisdom or technicality in order to understand what is his risk profile, what is he able to accept in terms of downside, upside, what is his objective. And then, to paraphrase Mr. Saylor, don't try to do it yourself. Find the best guys in the room that are doing that for quite a while and have proven results, and trust them.
Thank you, gentlemen. So I think we're ready to open for questions. If there are any questions from the audience.
So I know the theory is always say never sell your Bitcoin. But shouldn't you possibly say sell your Bitcoin, but then turn right around and put buy orders in to buy on the way down? And that's one question I have. And the second question I have is, I know, Adam, you sold a lot of Bitcoin, but is in that way, is that a good thing that you sell Bitcoin to show that it has value so people can say, well, it's worth something? So people, the OGs who sell their Bitcoin, were you doing us a favor by selling it to show everyone that it is worth something, it can buy something?
I mean, I think it depends. I think generally people have. I mean, the way the Bitcoin sort of gets its market structure from the survivors, right? So the people that remain holding it, it's quite volatile, so people can to get shaken out. It's quite difficult to time the markets, and my observation early on was that it's highly volatile because it was a bit earlier when the volatility was higher, but effectively over the long term it's some kind of exponential function, and so the odds are stacked against you. You know, each day of out of market feels more risky to me than staying in the market. So, you know, and I think Saylor has said similar things, that he tried to do something many years ago with Apple stock and regretted it or something, right? So if you have an investment that you believe in, the simplest thing is just hold it. Now, yeah, you can maybe make money by selling the top, but where's the top? You don't know. Now, I think there are some tactical ways that a Bitcoin treasury company can sell Bitcoin. So one that MicroStrategy did a few years ago is tax loss harvesting. So that's just a clever way to sort of do a bit of tax efficiency arbitrage, you know, sell a bit of Bitcoin with a low cost and, you know, offset some gain and buy some Bitcoin back. So it's, you know, it's part of a tactic to end up with more Bitcoin ultimately. And then the other thing is with a treasury company that they are trying to increase the Bitcoin per share. And so you see, particularly in the sort of when the market is stressed, some of the treasury companies end up with a low MNAV, and so there can be a point where it actually makes economic sense in a Bitcoin per share terms to raise capital with a stretch-like product and actually buy the shares. If the shares are below 1 MNAV, that would actually be more profitable. And so if you like, that's a form of selling Bitcoin because you're buying something else than Bitcoin, but it doesn't grow the company in terms of increasing the number of shares, but it increases the Bitcoin per share, which is what the individual shareholder cares about, right? You know, does the Bitcoin per share increase for them, because that is a long-term metric for, you know, the hard asset value under the shares.
Maybe might add to that. I mean, maybe someone could learn from my mistakes here. So I think that's a really good question. Like, should you sell? And so I started out the Chicago Board trade. So, you know, equally comfortable long and short. Love trading. Been trading since I was 12 years old. Started trading commodities in college, and I got into Bitcoin around 2016. Friends of mine had pointed it out in like 2014. I put it on my Bloomberg, watched it. Ran up to that 1200 area, came back down, got my first order in. I tried to open an account through Coinbase. Of course, back then, Bank of America thought it was a fraud thing that was going on with me, requesting to move money to Coinbase. Took days. So, you know, the 250 I was trying to get was 465. And then as a TradFi guy, you know, I'm watching this, and it goes to 13,600. I'm like, you know, this is crazy. I've made 38 times my money as a TradFi guy. I got to ring this register. And so I did. And I watched it go to 20,000. And pulling my hair out over the holidays. And then I'm like, God dang. And so then it came back down. I looked at the charts. I'm like, okay, well, maybe, you know, if it gets back down, I think it was 1,700. That was like a big, you know, like the 85% correction or whatever. And I was like, all right, if it gets down there, I'll reload. And so, you know, by the grace of God, Bitcoin comes back down and Sean's long again. And I'm like, oh, thank God, okay. And then I'm feeling pretty good about my sale, right? And then it runs back up to 20,000. And I'm like, oh, this is going to be a double top, you know, because I got the TradFi hat. And, you know, so I sold it again. And I watched it run to 60,000. And that's torture. You know, that's really painful. And you're sitting there and you're pulling your hair out. And you're like, damn, like, how do I get back in? You know, and is this thing going to run to 100? You know, and then so, you know, I was like, well, on the technical side, if I could get in around 17, you know, this would be worth the trauma. Okay. Pay for the therapy. And so, you know, got to 17, got back in there, and I watched it go up to 60. And I'm like, okay, I think I've learned the lesson. I'm not going to sell it. I'm just going to let it run. And so my point of view on this is it's really time in the market. It is the power of compounding. Let's say use the example of compound interest. The power of compounding is just so powerful. Just don't fool around with it too much. If you need the liquidity, nowadays there's so many different tools that you can access with borrowing against your Bitcoin or doing something like that. I mean, basically, what Elon and these other folks, the sophisticated Silicon Valley guys, do is they have their stock and they never sell stock. They just borrow against it when they need to raise some capital. And I think that's now accessible to Bitcoiners. And so I'd say, don't maybe take some money off the table that way.
So I guess, looking at this summer, I don't see any good news. I see IPOs, I see AI. I don't see Bitcoin getting one bit of love until October. And for so many people who disagree with the 4-year cycle, it certainly sounds a hell like we're still going to fall into a 4-year cycle. And from June until October, I think it's going to be a tough market. So, thoughts?
Well, I think actually Adam and I have been talking about this a little bit, and the whole SpaceX IPO and the OpenAI and Anthropic IPOs might be what tops this market out. Right? You may satiate the demand from the the disequilibrium between buyers and sellers, and the S&P has been crazy, and I've been pulling my hair out a little bit there too, because I flattened out some S&P risk, and I'm thinking this is just getting kind of silly on these valuations and concentration levels. I think we now have the top 25 equities account for 40% of the market cap, which is higher than what we had in the dot-com crisis in '99. So if I put on a contrarian hat, and I think sometimes you have to think in a contrarian way to make any money. My guess is that it might be the SpaceX IPO and the Anthropic and OpenAI IPOs that are put the top in the market.
As usual, I want to be a bit contrarian. I think that I'm a huge believer in active management. And one of the reasons this space has lost some power in traditional finance is precisely because central banks started to print money as soon as equity markets were tumbling for one reason or another. This was since the credit crunch, so it's quite a while. But actually, in digital assets, this will not happen. You will not have a central bank printing money when things go up and down. So what's the answer to that? Probably active management. And it is about buying and selling using predictability as almost a scientific approach to markets. So I think that this is not something that you should be doing by yourself. It's highly technical, and you have extremely talented people that have spent all their lives trying to find these types of approaches. So I think that actually buying and selling Bitcoin is not a problem whatsoever. Actually, I think that if you want to accumulate Bitcoin per share, it's actually a good way to do this, is to trust people who are experts in trying to read what is going on statistically in the markets and actually finding entry points and exit points that are risk aware. And the goal is to have the best possible risk adjusted outcome, not just the price. So I think it's actually the way forward in digital assets, precisely because you will never have a central bank that will actually just print money, which is long-term problem and long-term pain, right? So yeah, I think you should do this.
Yes. To conclude this, I sold my Bitcoin at 113, so I'm still quite waiting for repurchasing, but no, it's not the question. My question is, I would like to understand a bit more the structure and the relation between BSTR and Blockstream Capital Partner, because it's not extremely clear to me, if it's possible.
Yeah, they are different entities. So there's no, yeah, there's no neither is a subsidiary of the other. Actually, all three, BSTR, Blockstream Capital Partners, and Blockstream, yeah.
Yeah, all have separate boards, separate management teams. Adam serves as CEO of Blockstream and BSTR, but there's separate management teams within each company, so they're pretty independent of each other.
Thank you so much. Round of applause for our panelists.